Hello, listeners, and welcome to another issue of REIKnowledge.com archived newsletters. You've heard of books on tape? Well, this is newsletters on tape. REIKnowledge.com. Learn from let's tap into the minds of seasoned real estate investors, learn from their mistakes, and leverage their successes. And we are firm believers that you should always be learning. In this newsletter summary, we're going to go through a golden nugget, and that's centered around, does 100% financing really mean that there's no money at the table on behalf of the borrower? And of course, we have supporters that help us pull these articles together, as well as this video. And this particular supporter is Rehab Financial Group that's supporting this video. All of our nuggets, by the way, come to us by way of contributors. These are not gurus in the industry. These are regular, everyday people who are out there doing deals, making mistakes, having successes, learning lessons, and they're sharing those lessons with our readers and our listeners. So we want to appreciate their support for sharing their knowledge to us, and of course, as well as our supporters, and in this case, Rehab Financial Group. So 100% financing, does it really exist? Well, actually, yes, it does. And Rehab Financial Group is one of the companies that offers it. They offer 100% financing of the purchase and rehab on 1 to 8 unit properties to both newbies and experienced investors. And they do that in 39 states. So they're essentially financing 100% of the purchase and rehab up to 70% of the ARV. ARV stands for after repaired value. The right lender can make the future of your rehab project look promising. It gives you maximum leverage, which lowers your cash in the deal. But does 100% financing mean no money at the table? The terms 100% financing can actually be a little misleading. So let's take a closer look at just how it breaks down, what it is or is not, and what is required from the borrower when 100% financing is used. Of course, the type of finance we're talking about is purchase and rehab financing. Typically, that's used on 1 to 4 unit properties and will be a loan amount of either 100% of the purchase and rehab or 65 to 70% of the after repaired value, whichever is less. So the purpose of this nugget that we're sharing is to help anyone who's seeking or has ever considered using purchase and rehab financing and has been introduced to 100% financing to gain a complete understanding of just how the loan product works. You know, given the name of the loan product being 100% financing, you would think that it would be sufficient to be able to understand the product. However, it's a little bit more complicated than you might think. The loan is commonly used and involves the purchase and rehab of either a single family property or a property that contains 2 to 4 units. Typically, the loan amount is equal to either 100% of the purchase price and rehab or a percentage of the after repaired value of the property, whichever is less. These are key words, whichever is less. So it's always either going to be a percentage of 100% of the purchase and rehab or a percentage of the after repaired value, whichever those numbers is a smaller number. In other words, if the purchase rehab amounts fit within the designated after repaired value figure, then the borrower basically has a zero down deal. So let's talk for a minute about the ARV. This is a crucial number, a crucial figure in our formula. The ARV is the after repaired value and it's determined by a licensed appraiser. And the loan is either 65 or 70% of the ARV maximum, depending on the experience of the borrower. More experienced borrowers get that extra leverage, that's 70%. New borrowers or lesser experienced borrowers usually get the 65% maximum of the after repair value. What is considered costs in any type of formula like this is the purchase price, a combination of the purchase price of the property and the rehab amounts. That's what they refer to when they say costs. In order to gain 100% financing, the cost, which is again is the purchase and the rehab, must be no more than 65 to 70% of the ARV. If it exceeds that number, then you're really not getting 100% financing. Can it be done? Absolutely can be done. So just what is the golden ARV figure that the purchase and rehab amount needs to fit within? Well, the answer to that actually depends on the recent experience level of the borrower. Normally, the track record of experience is limited to the most recent 3 years. The lender seeks to know how many real estate related transactions involving either rehabbing or new construction was done by the borrower with ownership within over the period of the last 3 years. This supplies the comfort level of extending the leverage, the loan to value, to the borrower. Hence, the larger the number of the transactions completed, the larger the percentage of the after repaired value, because the lender feels more comfortable with the experience and track record of the borrower. So circling back to the 100% financing formula that we previously mentioned, the loan amount would be equal to either 100% of the purchase and 100% of the rehab, or 65 to 70% of the after repaired value, depending on the borrower's experience, and also whichever of those numbers is a smaller number. If 65 to 70% of the ARV figure is lower than 100% of the purchase and rehab, then that lower figure becomes the loan amount, and of course that means 100% financing is being used. So in order for 100% financing of the purchase and rehab to apply, the total cost of purchase and rehab must be no more than 65 to 70% of the after repaired value. If it exceeds that, then the borrower brings the difference to the closing table. Now you might be asking yourself, if the ARV is such a crucial figure in this formula, who determines the ARV? Good question. The answer is it's determined by a licensed appraiser engaged by the lender. The lender will typically request a two-part appraisal. They want to know what the as-is value, which means the current condition, the way it says now, and comparables for that. And of course, future value, which would be what it'll be worth after the rehab is completed, and they want to see comps for that as well. Then usually the lender will share that appraisal with the borrower. So is money needed at the table by the borrower? Yeah, typically, because the borrower brings funds to the table, normally at least to cover the fees that the lender will not typically finance, or in a case where perhaps 100% financing didn't cover all the purchase and rehab because it exceeded the percentage of the after repaired value, they're bringing the difference. So as we mentioned, the costs do not fit. If the costs do not fit within 65 to 70% of the ARV, then yes, the borrower is going to be bringing the difference to the table. There are fees that the lender typically will not finance, fees such as the lender origination, which is usually a percentage of the loan amount, the lender fees for processing, underwriting, money wiring, doc prep, and so forth. Sometimes they'll even collect some prepaid interest at the table. And then, of course, you have local settlement fees for your settlement agents, your title insurance, your transfer fees. So all those things are typically not part of the loan. So those have to be covered by the borrower at the table. So even when 100% of the financing of the purchase rehab amounts is being financed, there are still costs and funds associated with the transaction that are covered by the borrower at the table. So the borrower needs to factor these into their equation whenever they're doing the numbers of the project. So the borrower must show reserves to start the rehab. The borrower must have sufficient funds to start the rehab until they request the first draw for work being completed. The funds that the borrower needs to show for proof of having typically around 15% of the rehab budget, or if it's new construction, 15% of the construction budget. So if the rehab budget is, for example, $50,000, then the borrower has to show 15% of that, which in this case would be $7,500. Those funds being over and beyond the funds needed by the borrower at the closing table. So in other words, you're not bringing these reserves to the table, but you have to show that you have them to be able to start the rehab. If you're seeking a figure that is required in the way of funds by the borrower, even when 100% of the financing and rehab is used, perhaps it's better to target somewhere between 10 and 30% of the total cost of the project, depending on how the numbers play out, for the liquidity needed by the borrower. Once again, typically, in addition to the money coming to the table for covering the things that the loan does not cover, the borrower has to show that they have ample liquidity to cover 15% of the rehab budget or new construction budget, also 6 months interest payments, and as well as the cash needed at the table to cover the fees that the lender does not cover. So the use of other people's money as leverage in real estate can be a very powerful tool, as it replaces the need of your dollars to be exposed. However, it does come at a cost. And essentially, 100% financing doesn't really mean that you won't have any of your money in a deal, because we talked about there are things that are going to have to be covered that the lender's loan does not cover, but it does mean that you'll have much less of your money in the deal. Once again, we want to share with you that it was Rehab Financial Group that was our supporter for this video. Leverage to us is using other people's money for profit. More of their money, less of yours. Rehab Financial Group offers 100% financing on 1 to 4 unit properties for either newbies or experienced. And if you're an experienced investor in multifamily, they also offer financing on 5 to 20 unit properties for those experienced investors. You can reach them by either email or phone. The email address is rob@rehabfinancial.com. The phone number is 215-913-1580. Now, we would like for you to engage with us either through our Facebook group, our YouTube channel, or our Facebook page. And of course, all of them are referenced as reiknowledge.com, whether it's the group, the page, or the channel. We would also invite you to subscribe to our free weekly online newsletter at reiknowledge.com. It supplies knowledge, resources, and contacts to investors of every level, newbie or experienced or even well-seasoned, all at no cost. Once again, the articles and nuggets that we share are from contributors from hands-on deals done, mistakes made, lessons learned, and successes shared as well. So once again, we think you should be tapping into the minds of seasoned investors, learn from their mistakes, leverage their successes, and always be learning, because knowledge is power.